Before you can consider building a small forex account, you need to know these three elements or these three steps. One is psychologically having a proper mindset. The second is having a proper risk management strategy, which a lot of people don't even talk about. And then number three is, of course, having a actual solid trading strategy so you can start making bank. And this applies for a $50 account, $100, $500, and $1,000 account.
Anything is possible. Anything. Just over a year ago, I was making $30K a year with my 9-to-5. And now I'm making well over $100K doing what I love doing. And that's all thanks to Forex. Your boy Solo.
All right, so first let's talk about the psychological mindset of actually building an account. So when you guys look at trading, and we're actually just going to focus on the charts here. But when you look at trading, and let's say that you might have a very successful day, right? Let's say that you have a day where you're making 10% gains, 20% gains, even 30% gains. And the next day comes where you lose all of those gains, and then you try to go back to make that gains back. No, don't try to do that, because that is what, of course, is going to affect you guys in trading. So here is psychologically how you can have the proper mindset in trading. Is having rules. You must have rules applied. Now, I'm going to give you my actual 3 rules that you guys can use. So when you actually get into trading, you will understand exactly what to do. Rule number 1 is you want to wait on confluence. Confluence can apply for anything when it comes to multiplying strategies together or ideas together. Now, the second thing that I look for is price action pattern. And the third thing I look for is wave pattern / market structure. So these are all of my 3 elements that I look for before I actually take a trade. So this helps me out psychologically. So I would know, all right, you know what? I'm not taking any trades. I'm not disobeying any of my rules until these rules follow. So when it comes to confluence, just to kind of help you guys out, one of the confluences that I heavily use is the Fibonacci retracement. So I'll just say Fib retrace. And then also I use the Fib extension. When it comes to trading, I do something called Elliott wave trading, as well as price action and market structure. So I combine all of these different strategies and techniques and theories together to make a very simple unique strategy for myself, which I'm going to be showing you guys at the end. So that is basically the rule number 1 of pretty much figuring out the psychological mindset. It's you just have to be disciplined. And one way to be disciplined is having rules. Without rules, every trade you take is going to be a bad trade. With rules, any trade you take that goes against you is not a bad trade. It just didn't go in your favor. So follow these, write these down. Now let's go into step 2. So step 2 is one of my favorites, risk management. Now, for anybody that don't know what risk management is, this is a huge factor when it comes to trading, because when you are trying to handle money, move money, and grow money, you need to understand risk. You need to understand how to manage it too. So this tends to be one of those where people just say, forget that, I don't want to learn it. Well, I'm going to be honest with you. This is why 99% of people is failing in the trading world. And to be honest with you, a lot of people don't really talk about risk management. So I'm here to basically talk to you guys about how to strategize risk management and how to actually figure out this so you can start growing these small accounts. So let's go ahead and look at the percentages, which is very important. So let's say that you are looking to risk 3% per lot. And what do I mean by 3% per lot? Very simple. If we go to our Fibonacci calculator, which I will link down below that you guys can check out, you guys will have this here. So let's say that we are trying to get in a very major pair, very common pair, Euro USD. Let's say that our account balance is $1,000. And we're not trying to risk no more than 3% on that position of that trade. So let's say that we got in a trade, we figured out our risk to reward, which I will explain in a bit. But after we figured out and established our risk to reward, now we see that our stop loss is, let's say, 20 pips out. So now we know our stop loss is 20 pips out from our entry. So what do I need to enter? How many lots do I need to enter before I get in this trade so I do not risk no more than 3% per lot? Very simple. You hit calculate, and now if you look at the standard, it's basically telling you exactly what is 3% and how much you should not go over when it comes to the actual standard lots. So we're looking at 0.15 lots. So when you guys are pretty much getting in that particular trade, you do not want to go over 0.15 lots, and you want to at least have 20 pips. So now what this does is establish for sure that, all right, I'm not risking no more than 3%. So I'm all good. Now, this is one of the strategies that I have used to actually pass the FTMO. I know a lot of people ask me, what are you doing? It's not an actual trading strategy. It's everything that I teach you guys on my YouTube channel. It just really comes down to strategizing the risk management part. So I basically have this rule where I do not want to risk no more than 4% per lot. So meaning if now, let's say that you want to enter in multiple lots, but once again, you also have something called a daily standard, meaning that you don't want to risk no more than 10% per day, or you don't want to risk no more than 5% per day. That will basically go and apply for this same way as well. So what do I mean by that is simply, let's say that you have, I do not want to risk no more than 5% per day, right? And how you would go about that is very simple. When you're entering in different lots, let's say you want to enter in more than one lot, and you want to enter in 5 lots, you just do 1%. So let's see, what is 1% if we have our stop loss at 20 pips and we're entering in Euro USD with a $1,000 account? We're now looking at 0.05 for our standard lots. So now that tells us we can do 5 of these exact same trades and risk no more than 5% per day or 5% per lot. I'm gonna just stick with per lot. So now this puts you in this position where you officially know what's going on. You officially know, okay, you know what? I'm not going to risk no more than 5%. And if I do, then I'm done for that entire day. And that's basically how it's done. So if you guys have that strategy where you do not want to risk no more than 3% per day, and you have a daily gain, meaning that you have a daily profit of 10%, you can have a very successful trading career. So let's just say that we have this calculator here, and we're looking at this calculator. And let's say that we have a $50 account, and our gains, which is our increased percent here, is 10%, meaning that we are looking to gain 10% hopefully per trading day. Trading days is this here. Now, of course, this is just a perfect world. You might have some losing days. That usually happens. However, let's say that we are looking to do at least 10% per day. Well, if we do a 10% per day, very simple. How it works is we are not risking no more than 3% per this lot, but we want to do a 10% gains based off of our actual daily gains. So now what we can sit here and say, all right, let's say day 1 comes, we just made 5%. Day 2 comes, we made $5. Day 2 comes, we made $5.50. Let's say that we go all the way down to 10,000. If you guys have this proper risk management strategy in play, you can literally get to about $10,000 in about 80 days, 81 days, 81 trading days. The broker you guys want to use is down below to sign up with them. Make sure you sign up with them. This is great for actual scalpers. If you want to scalp, if you want to grow a small account, I highly suggest using that broker. The link is in the description to sign up with them. But if you guys use the broker, the correct broker, that is possible. So if you stick to that, that can definitely give you what you need. Now, when it comes to looking at the daily gains, you want to at least try to do 10%. Now, 10% might be a little high, but you guys can set your own numbers. It just varies on you. You just want to have the proper risk management strategy in general. All right. After that, your risk to reward. Now, what is risk to reward? Risk to reward is basically saying how much are you willing to risk to gain. If you, let's say, want to risk $100 to make another $100, that is what we call a break-even 1-to-1 risk to reward trade. Let's say that you are looking to risk $100 to make $50. That is what we will call a bad risk to reward trade, and you should not take that trade, because even if it goes in your favor, the consistency of you doing that will not be profitable. So when I say a 1-to-2, this means if you're risking $100, you're doubling up your money to make $200. So what happens is, if you win one trade and the next trade goes against you, but you still did a 1-to-2, and also you go back to not risking no more than 3%, and how you would know that is by having this calculator to figure out what proper lot size you need. You will know that if I lose one and win one, now my account is right back at break even. I'm cool with that. Unfortunately, I didn't get my 10% gains. I would try another day. Let's leave it alone. So that is how you guys have to look at risk management. I promise you, if you skip past this part and you do everything else congratulations. You probably will not get to where you want to get to because this is very, very important. I highly suggest that you guys really understand the risk management part and understand the risk per lot and the risk per day or the daily percent gains. All right. So now that we established that, I want to go ahead and get into the actual strategy that I have for you guys to trade. This strategy works very well with crypto and indices and even forex. All right, so when it comes to trading crypto and indices, the market tends to be very, very trendy. And I highly suggest that you guys look into trendy markets. Obviously, this is really how you make your money. It's easier to capture and it's easier to analyze. So when market is coming from any consolidation, rather if it's a ascending, descending triangle, rather if it's a flat, meaning it's ranging, or whatever it is doing, equal highs with equal lows. What an equal high is when price does not break the previous high and it creates what we call a double top. An equal low is where price does not break the previous low, and that's what we call a double bottom. So if we notice price is doing that, we do not trade. Now, if you guys go on a 5, let's say that this whole scenario is on a 1 hour time frame, but you're now on the 5 hour time frame and now you see a small trend. That's fine. You can do that. However, do not do that if the whole entire market is trending, rather if you're a 5 hour daily time frame. So now the next step is we have to wait on market to break structure, because as a retail trader, we need to know beforehand if the market is going to continue up or not, right? We don't have that type of liquidity to pull the market, to move the market with what we are offering on the table. So what we are going to do is be patient, okay? And for us being patient, what this will do is give us a true signal if the direction of the market is going to be biased to the upside, or if the direction of the market is going to be biased to the downside. Regardless, we will know by it breaking previous highs or previous lows. So if you guys look here, this is what we will call a previous high. We'll just call this a higher high, HH. If market ever breaks this, you will then not just get in the trade. You're not getting the trade yet, but you're going to wait on price to break that high to confirm that is now going to be most likely an uptrend. Now that we established that price just broke out of this high, before we get in the trade, you can think of this as your breakout retest scenario, but it's reversed a little bit. Before we get in the trade, here's what's going to happen. Two things is going to happen. The market is going to always react off of previous structure. Always. Rather if you see it on a higher time frame or not, it will always react. Maybe on a lower time frame. So that now goes to my rules, which I have right up here. We'll bring that down. You guys will see that I have my rules now. My 3 rules is price action pattern. It will be double bottom, double top, head and shoulders, inverted. Wave patterns will be Elliott wave, correctional patterns, and or market structure. So seeing that market structure broke here, creating a new high. Now I know every time price breaks structure, we tend to get what we call a corrective pattern. So what I usually see as far as Elliott wave, as far as all my Elliott wave traders out there, I see that we have a corrective pattern. Now this can be known as a flag pattern right here. If you guys look, we have boom, boom, boom. This could be known as a flag pattern, a triangle pattern, depending on how many legs or how many waves we have inside this corrective pattern. It can be one of those, right? However, I'm looking at it like this. If we take that out and let's just say we don't know anything about Elliott wave, don't worry about it. The next thing is we need to look for structure first. After price breaks the new high, we have to look for structure down below, known as a higher low. Only way structure is formed is when it hits an area twice. If it hits an area twice, that's where price action is also formed, creating what we call double bottoms, triple bottoms. So if we establish that we have one of those type of patterns, we then go ahead and take the trade. After we get one other thing that I forgot to mention, and I'm going to put this as number 1 as well, and this is candlestick pattern. Now, candlestick patterns, we're looking only for a couple candlestick patterns. One, we're looking for inverted hammers, or wicks, which is more price action momentum, or we're looking at engulfings, which I talk about so much all the time. So seeing that we pretty much got wicks right here. Let's say that we got multiple wicks right here after establishing that price just reacted off of this level right here. We got multiple wicks. Now we're just waiting on one other confirmation. So right now, all of our 3 confirmations that we have will be it broke market structure to create a new high, which is here. We have a wave pattern for those that know wave patterns. If you don't, subscribe to my YouTube channel. I talk about this all the time, baby. Other than that, we have wave patterns, and then most importantly, we can go into number two, since number three is wave patterns or market structure. Number two is we have a price action pattern. Now we have a potential double bottom. The last thing we need is confluence, either using the Fibonacci retracement, Fibonacci extension, or the candlestick patterns. If you guys look at candlestick patterns, you wait on an engulfing candle. If you notice that engulfing candle has formed after you got all of these 3 wicks, at least, you then go ahead and take the buy. So now what you would want to establish is now looking and make sure that you have a 1 to 2 trade. So let's say we do a 1 to 2 trade, and a 1 to 2 trade is very simple. If you guys don't know what I'm using, this right here is what we call long positions and short positions. This is to help you figure out your risk to reward. And this is very, very important for those that's just getting into trading, or for those that never use this. This is a very useful tool for you guys to use. So let's say our entry was somewhere around here. How I know that this is a risk 1 to 2 is because it says 2. If it was anything about 1 to 1.58 is not a 2, is exactly what it is. 1.58, you're basically risking whatever amount of pips down here to gain 1.58%. Or you can look at it to gain 6% by looking at this number up here. All right, so that's basically how that works. And if you guys ever need more information on that, just comment down below. I would be happy to do a whole entire video on that. But let's say that we got a 1 to 2 trade, right? And we're basically not trying to risk no more. Let's say we're putting $100 in this account to double up our account. Basically, bada boom, that's how it works. Also, you can look at this percentage here, basically telling you that 9% of gains as well is potentially what will happen there. So that goes right back to my daily gains, what I had mentioned earlier. Guys, daily gains is 10%. So once you hit that 10%, even if you got in one trade, leave the market alone and do not trade until the next trading day. Otherwise, you will be basically over trading, and now you're going to be in the point where you just wipe your entire account. So this is pretty much what you will do. You take this trade, get in, boom, and that's how it works. So that is basically how you guys will trade when it comes to crypto and when it comes to forex and indices. So I just want you guys to understand there are 3 rules to trading and having a proper way of building a small account. And if you don't follow these rules, then it's going to be very difficult on building a small account. You could turn a $50 account to 10K. You guys see the potential. And if you ever want to see more potential, just comment down below. I will give you guys more gems, and I will see you guys in my next video. Once again, your boy Solo. Take care, everybody. Peace.
I've been out here feeling me on a regular, fucking with this dream, preparation. You don't like I'm on that same shit, let me elevate you. Working through that patience, termination. This is how it is, tell me now. You really with it, then I'm feeling I've been out of line, man. I cannot catch me out my temp, been a lot of high.